Hi, welcome to our 5 question Friday. This is for last week. As I mentioned in the previous video, I was sick, so I couldn't do the last week 5 question. Now, the first question, we have one of question from our members asking, who determines the value of currency pair? Now, a simple answer is the seller and the buyer. So anything that you trade in the open market, whether it's stock or currencies, generally speaking, the price always determined on the supply and demand. So depend on if the seller and buyer can't come up to a negotiated price that they both like. Of course, in real life, it does not work that way because for the seller, they want the price to be as high as possible, and for the buyer, they want the price to be as low as possible. And in terms of stock, you have a money maker, a market maker. So the market maker's job is to match the seller and the buyer. Now, in currency market, there's no such thing as a market maker. So a lot of reason the currency market can be so efficient and so fast is because I'll say 70 and 90% of the players are speculators, and that is us, and that is why we as a speculator is actually a very important part of currency market because there's no money maker in the currency market. So of course you still have one seller who wants the price to go as high as possible, and a buyer wants the price to be as low as possible. So you want to buy low and sell high all the time. Now, the reason that the market can be so efficient in currency trading is because there's so many speculators out there, so that the speculator makes the price match each other, and that's why your order can be filled and your spread is relatively small as well. And that's why to answer the question, who determine the value, it's actually determined by the seller and the buyer. But just to give you a side note, that is why sometimes you don't want to trade when there is no momentum, when there's no market. For example, you don't want to trade in between sessions, especially right after New York close and Asian opens, or before Asian opens. Those are the time that relatively there's no volume. Now, when there's no volume, you generally see that there's a huge spread in the currency pairs, and the reason is that there's not much speculators, there's not much players playing that market right now. That's why, in order to match a transaction, you have to have a huge spread. So that's why you have a bid, and you have to sell and buy. There's a huge price differences in this kind of market, and that's why I would suggest people speculating in the currency market, day trading, always pick the time zone that is relatively fun. That's, there's a lot of people gonna be joining this game and playing, because you will have very little spread, and that you have to take in consideration in trading, because you don't want, sometimes the spread will really kill you, and the spread will really mess up your stop loss and all that. So again, the price of the currency pair is determined by the buyer and seller, and the reason sometimes you have a small spread, sometimes you have a huge spread, is because determined if you have a lot of speculators playing in the market. Occasionally, your broker will be the so-called money makers. That means they will take whatever price you have and match with you. I don't really have a comment on that. Because I think at the end of the day, if you're a good trader, it doesn't matter. A lot of people think that the broker will be trading against you. Realistically, it's because for a broker to do that, it makes sense because 90% of traders lose money. So they want to trade against their client because they anticipate you to lose money. So of course, there's different strategy to handle different situations. But generally speaking, in the currency market is an over-the-counter market. So there's no central location, and there's no market makers. So the price is purely determined by the buyer and seller. So that's why you might have one currency pair at exactly the same time traded in slightly different price quote in two different brokerage. Is because the price is determined by the seller and buyer in that brokerage, and then when it's sent to the market. I hope that answered your questions. Good thing about this, I think personally, is that the efficiency of the market. You don't really have to wait for the price to match. I trade stocks at the same time, so sometimes it happens in the stock market where you will not get filled. Well, it's not because of limit down or anything. It's just the price that you select. Maybe there's just no buyer and no seller. Especially if you trade, you don't trade blue chip stocks. If you trade penny stocks, then that's what happened. But it rarely happens in currency, is because the huge amount of volume and the speculator. Okay, I will come back with the second question, Q&A, and stay tuned. Thank you.